Welcome to the Credit Clubhouse podcast, a deep dive into the world of credit markets and alternative finance. Before jumping into our next episode, we have an exclusive offer for our listeners. Just head to dealcatalyst.io, pick any event, and then enter the promo code CREDIT at checkout. This will provide you 10% off any ticket to any conference. This offer is limited to the first 50 ticket buyers. Don't forget, we want you to follow the show, rate us, and leave a review. We encourage your feedback, and we want to hear from you, the listener. The next episode is presented by 9fin. Every day, you're making decisions that matter. Which credit to buy, which deal to pitch, which covenant terms will hold. You need the right intelligence, you need it fast, and you need to trust it. That's where 9fin comes in. One AI-powered platform with complete visibility across public, private, and distressed credit, built for how credit teams actually work. Head to www.9fin.com/demo to request a 30-minute personalized demonstration. Again, that is www.9fin.com/demo. And now, on to our next episode. Welcome back to our latest installment of the Credit Clubhouse podcast. As always, I'm your host, Todd Anderson, head of content and programming at Deal Catalyst. Joining me today is Aaron Kless, CEO and CIO at Andalusian Credit Partners. Aaron, thank you for coming on the show today. Great to meet you, and looking forward to our conversation.
Thanks, Todd. Great to be here, and thanks for having me on. I'm excited.
Well, let's get right into it. So, you've obviously, when doing research for this episode, I saw, you've been at some of the Wall Street's biggest and most well-known institutions. When thinking about launching Andalusian, what kind of opportunity did you see out there? You felt, all right, this is the time I should do it, and this is conceivably what the market is missing.
Yeah, what we saw when we sat down to kind of put this business together, Andalusian Credit Partners, was really an opportunity almost to kind of go back to where private credit began, back to basics, back to the middle market is really what I'm talking about. Been at some, as you mentioned, some of the biggest firms in alternative asset management and private credit. And over the course of my career, I watched those firms and was a part of the growth of those firms. And as those firms and those platforms got bigger and bigger, moving kind of up and up market, bigger and bigger deals, what I saw with the opportunity with Andalusian was to kind of refocus on the true middle market. We call it the core middle market, and really go back to where private credit began, which was, making loans, private loans to true middle market companies.
Direct lending has clearly become very crowded. So why do you guys believe the non-sponsored middle market represents, a more attractive, or maybe rephrase that, the most attractive risk-adjusted opportunities today?
So it is true, private credit, particularly direct lending, has gotten incredibly crowded. Part of it was what we were just talking about a minute ago. The firms who really are the household names, let's call them, in direct lending. They've gotten so large, and they've had to kind of move up market to do bigger and bigger deals, to write bigger and bigger checks. Kind of leaving that, I won't know if I go so far as to call it white space, but less competitive space in the middle market. So when we think about, kind of finding that optimal and attractive and differentiated risk-adjusted return for our investors in senior secured cash flow direct lending, first and foremost, it's that focus on that, what I mentioned, we call it the core middle market. And secondly, as you pointed out, Todd, it's our focus on non-sponsored direct lending. And what we really love about non-sponsored direct lending are kind of what I call the three pillars of non-sponsored direct lending as you're considering a non-sponsored deal versus maybe a similar sponsor-backed borrower. And that's really, kind of wider spreads. Everyone likes to get paid more, lower leverage, right? Less risk. And then number three, which, starts to get a little bit more technical for people who love credit, are those tighter terms, tighter docs, right? It's not just, a turn or a turn and a half or two turns less leverage. It's not just 100 or 150 basis points more spread. The devil's in the details. When you get into your credit agreements, that's where really you can tighten things up and really have those lender-friendly terms and those lender remedies that allow you to really take that view that this is really an attractive risk-adjusted return.
Obviously, direct lending has been in the news a lot the last year. Some of it, obviously, more headline than reality. But has there anything in the market that has shifted? I mean, you referenced there at the end towards docs, and when you think about structures, pricing, even docs, that has shifted over the last year as some of these kind of headlines have creeped into the space. Maybe investors are asking more questions than ever
Yeah.
before. How has the last year, 18 months been?
Yeah, I'll give you sort of two answers. One is aspirational, and it's a positive aspiration. So we've been, part of our strategy is we think that an important part of our focus is on covenants, right? That's in those docs, right? So
Yeah.
all of our deals are covenanted deals. That's a real important thing for us. It's top of our list. We think that covenants matter. They matter in the day-to-day kind of borrower lender relationship, and they certainly matter in moments of stress or distress in terms of getting that seat to the table. The sooner you get to the table, the better the outcome ultimately as a lender is going to be. So that's my aspirational answer, is that I think over the last 12 months, I think lenders are getting a little bit more attuned to the value of covenants.
Hmm.
The cov-lite market, we've seen that market creep down, 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 from started in the broadly syndicated loan market into that upper middle market, ultimately into the middle market. And I'd say over the last, call it year, during this period of a lot of intense conversations around private credit, I do think, or I do hope that investors are starting to really agree with us that covenants do matter. So that's kind of the first part, but my first answer to you. And the second answer is, in the last 12 months, or maybe less, maybe more like 6 months, it kind of entertains me to no end to hear the sort of mass media or talking about these names in private credit as if it's sort of like a normal thing to be talking about, this little kind of funny nichey thing that we do. Suddenly to hear mainstream media talking about private credit just kind of entertains me. But it is important, right? It means that
Yeah.
people are paying attention to the industry, and that's a good thing.
So obviously, one thing that's a little different for your firm is, more of a sector specialization. When you think about sports, media, entertainment, financial services, why was that aspect important when launching the firm, and obviously still important to the ethos more versus maybe a broader, more generalist strategy?
Yeah, so as I said, kind of at the top, when we sat around to design this firm and this strategy, back to basics, back to the beginning, back to the middle market, that was sort of the genesis. And then beyond that, it was a few other things. We talked about the non-sponsored part of things, that having that in the mix, that risk-adjusted return, and then really importantly was also kind of making the decision, and the conscious decision, I should say, that being an industry specialist matters, right? We talked about it already. The business, the industry is crowded, right? So there's
Yeah.
lots of generalist lenders out there. So where can we really differentiate ourselves as a manager for our investors? And ultimately, what matters is the returns, right? Differentiated returns for our investors. And really, we think of ourselves as a complementary and diversifying strategy, right? You can go get a bunch of great managers to do generalist private credit for you, upper middle market credit. But where can we really differentiate ourselves? So we looked at those industries where, one, of course, we were excited about the secular trends, and we can go through those. But equally importantly, where we can matter, we can differentiate, something that we call access. Where do we have access to great deals, but most importantly, access to information to do kind of better, smarter, faster underwriting. And that's really kind of was the genesis of focusing on those particular end markets.
So digging in a bit into one of the sectors, which is sports finance. I'm a huge sports fan. Um, my kids play sports. I mean, sports has been, a part of my ethos my entire life. But when thinking of it as an asset class, how well understood is the space? And B, what is considered the types of, pieces of the asset class? Is it NAL to, league rights to football team? Like what does sports as an asset class mean?
Yeah, so look, there's a couple things in there that are worth picking apart, and you're doing my job for me, so thank you. That first part, you love sports, your kids play sports, it's been a part of your life. That's the secular trends that we love about sports investing, sports as an asset class, right?
Yeah.
You're not just a customer, you're a passionate consumer of the product. And most importantly, you can also be a passionate participant in the product, right? So, or your kids or people that are important to you. So that's really exciting about it. And what does that, what does that result in when you think? So take that, but then put on your credit hat, your credit
Hmm.
investor mindset, right? When you have our, kind of, let's call it recession resilient, right? Sticky businesses where the customer, really wants to be there for the end product over time in good times and bad, right? That applies to your favorite teams, but also, economic cycles. It has durable, recurring kind of cash flow components to it. And then you can, that gets into a whole bunch of things like media deals, media rights, subscription, the way content gets produced, distributed, and consumed. So there's a lot about sports from a secular level that we really like. But then you ask another really good question was, well, what is sports as an asset class?
Yeah.
And there's sort of the headline part, right? Some team changes hands, or we just saw. I mean, it was announced, I guess, a few months ago, but the finalization of this Big 12 deal with Redbird, right? You asked about NIL, constant headlines around that. So there's sports as an asset class, which is professional sports, collegiate sports, financing kind of the changing landscape of collegiate sports through the rising cost of NIL. But there's lots of other parts of sports that still benefit from those same secular themes, which is where we kind of focus most of our energies. Those are those sports adjacent businesses, and those can range from sports adjacent to professional sports, amateur sports, collegiate sports, and youth sports, and then also recreational sports as well, right? And that's that kind of really dedicated customer who's going to prioritize that part of their life through cycles. So sports is a huge asset class. You asked the question, how well understood is it? I would argue it's getting better understood day by day. But really, it exists, I would say, in sort of two components. There's things in and around professional sports, and more and more collegiate sports is becoming professional sports, right? I've
Yeah.
heard I've heard athletic directors at really large universities say, we need to run our program as if it was a professional sports team. Our
Yep.
our football team is basically the same as an NFL team now. But it's those sports adjacent businesses and those amateur and youth sport businesses that get us really excited from a credit perspective.
And are you seeing any particular in either the adjacent or NIL that is offering kind of the most compelling opportunities in the market today?
I would say the stuff on NILs is probably the most interesting academically, right? Because it's evolving. That landscape is shifting literally as we speak, right? Hard to predict where that's going to be in, 12 months. Forget about, 5 years. It's hard to predict where it's going to be
Yeah.
in one
Yeah.
year. But what I do know, or I do feel very confident, is that private capital, both private equity and private credit, are going to be a part of that evolution for sure. The question is going to be, where, how, when, and not why. I think we already know the why.
What about like the congressional, the legislative aspect?
Yeah.
Because you feel like especially with NIL, professional sports, you kind of put them over here. Even the
Yep.
amateur sports and the adjacentness, it feels like there's a structure and
Yep.
um, a pathway that is at least steady there. And then you have this NIL, which seemingly you referenced it in your answer, which is we have no idea what it looks like in
Yeah.
12 months. So when investing in something like that, how do you take that into consideration?
Yeah, look, for us as a lender, credit investor, that is top of our list. I mean, it's really hard to know how that's going to play out, and I think it could be pretty binary. So you have to be careful, pick your spots, pick your partners. to be specific, what do I mean by that? I think as a lender, sooner than later, it's going to be easier to do single universities or single program deals than it is going
Mhm.
to be conference deals. Those are going to get the attention. Those have a lot more stakeholders. They're, who rightfully so are going to be very focused, and we've seen that already, right? We've seen that with a couple of deals that got announced and then kind of fell through. We've
Yeah.
seen that with how long it took to get this Big 12 deal kind of done, and now we're starting to see what some of the details are, and maybe it's not quite as dramatic and transformative as people thought. So you're right. There's huge stroke of the pen risk, as we call it, right, to change the landscape yet again around collegiate sports. So I think from a lender's perspective, proceed with caution, tiptoe, if you will, or dip a toe. And that's a lot easier to do working with a single private university or a single program than it is to do some of these more aspirationally transformative conference level deals that we've been reading about.
The other thing that obviously you guys certainly invest in and have an interest in is changing probably just as fast, which is media and entertainment.
Yeah.
Many
Yep.
years ago it was just a handful of cable companies. Now they're streaming, and seemingly another streaming app every few weeks. It feels like at times, but like the landscape of media and entertainment has obviously shifted as well, and that one's less of a legislative issue, but I'm sure there's a piece of legislation that could relate to that. But how do you look at investing something that's seemingly changing by the minute,
Yeah.
which is, either through more streaming or more deals or podcasts or whatever?
Yeah, no, a high pace of change in particularly on the content side of media and entertainment.
Yeah.
We've taken what I would say is a prudent credit focused approach. We try to stay close to the assets, right? So financing things like music, pools of music royalties or libraries of content, right? So the closer we stay to the assets as a
Mhm.
lender, right, the more comfortable we feel about that the known unknowns and the unknown unknowns about the pace of change. And a lot of the change in media and entertainment is technology driven, without a doubt, right? The impact of AI on everything from, production, including, screenwriting and all the kind of basics, and then obviously, IP rights and what are they and who owns them and what do they look like, and then technological things on the post production side. So we've tried to kind of stay away from that during this period of intense transition, particularly on the technology side, and stay close to the assets.
The other the a follow up kind of that just came to mind was, obviously with a lot of the media and entertainment, we hear a lot about the large and the massive transactions. But how much is done, as you said, in that core middle market that maybe we don't hear about on Bloomberg or whatever every day, but it probably makes up more of the structure and the real market within this sector, I would think, right?
Yeah, absolutely. I mean, look, there's an entire ecosystem of small medium enterprises that kind of are, the nuts and the bolts, if you will, of the media and entertainment space. And look, there's a handful of private equity firms that are true experts and specialists. So that's a big part of that activity. But it's also, a huge amount of non-sponsored deal flow as well, kind of in the, services, technology, distribution, parts of the ecosystem. As a credit investor, lots of equity opportunities there. We do see again, a number of really expert and highly successful private equity firms that are active there. And as a lender, we have to again be careful about where we pick our spots. But where we're seeing a lot of activity today, I would say, in the media, on the media side of things, lots of things around experiences, experiential marketing, live events, things
Yeah.
that people are really hungry for, sort of off the screen, if you will. And some of those are, kind of blur the line from sports to entertainment, sports as entertainment. So that's a real spot where we kind of think we shine. But also just traditional, kind of experiential things. And that can be, experiential marketing for brands, as an example, right? So there's lots of small businesses that don't make the headlines. Larry Ellison's not involved, Paramount's not
Yeah.
involved, no streaming services are involved, but they are kind of squarely, in that underpinning of the media and entertainment ecosystem.
I know we shifting back a little bit to the kind of current market and stress in the current market. I know there's been a lot of headlines that we referenced earlier, but where would you say is kind of the real stress in today's market?
So, I think, obviously the headlines, again, I'm talking about credit, specifically private credit. The
Yeah.
headlines have really been around software and AI disruption. So that's, I don't, we don't really do software lending at Andalusian. It's not really part of, kind of, again, where we think we can drive differentiation and attractive risk-adjusted returns to our investors. So that's not really a story that we need to spend a huge amount of time on. But look, AI is impacting all parts of the economy. So number one, software is definitely a big one. There is stress there. What I hear in the market when I talk to peers and friends at other firms that have a little bit or more software exposure, is pretty consistently that that these loans continue to perform, but longer term, the questions really are, how are these businesses going to adapt? And some will be successful at adapting, and unfortunately, others won't be. So I think that's one. I think the other area of stress in the market where we do spend quite a bit of time thinking about potential impact on existing portfolio, but also how it might impact new investment opportunities that we're looking at is really ultimately the health of the consumer, right? At the end of the day, that's who's buying the stuff that these companies are making,
Yeah.
selling, or servicing. And we're seeing obviously gas prices, inflation, consumer sentiment. So I think that's the other area where there is some stress or potential stress that we're keeping an eye on.
Yeah, you guys have, scaled pretty rapidly. There was a Carlyle joint venture, Goldman Sachs revolver. When you think about kind of the growth of investment capacity, how do you kind of couple that with not diluting underwriting discipline or the credit culture that you guys have created?
Yeah, no, that's really, really important. And when we, again, going back to sort of the basics, when we sat around to design this business, everything was done with an eye towards, what I call scale, right? And I don't mean scale, to be the next, kind of world's largest asset manager, where I have personal experiences with, but for where we're focused. So we're focused on that middle market, sponsored, non-sponsored, and those end markets that we know. So we've built, kind of a front end and an engine and a middle and back office that's designed specifically, custom designed to originate, underwrite, and manage those loans or portfolios. So as we add additional capital partners, both equity capital and leverage capital providers onto our platform, we're custom built to bring those on without really impacting how we do things.
When you think about, the partnership with Carlyle and your firm's evolution, how important does something like that become to the story that you can tell and just to the evolution of the firm for that, in some ways a stamp of approval?
Sure. Look, absolutely. Again, we built, everything that we do is quite conscious and consciously done, what we've put together. And built for scale. Carlisle is a fantastic partner for us. It is a stamp of approval, no doubt, right? It's a name that people recognize, and in this industry, in a crowded industry, that's really, really important. But for us, they're one important investor. We have a lot of important investors. All of our investors are important to us, and we know that in the future we're going to have additional important investors. So it's definitely a stamp of approval, without a doubt. They have been a great partner and great to work with, and we're really excited to continue to grow that relationship with them, as well as with other existing investors and future investors that we're speaking to.
Speaking of investors, what would you say are the biggest misconceptions that LPs have around especially I'd say more of the middle market direct lending landscape today.
Yeah. So I think as I think about that, I'd say probably the biggest misconception in private credit generally, direct lending and middle market direct lending specifically, I think there's a little bit of a misconception that, sort of everything's the same, that it's commoditized, right? Senior lending is senior lending, cash flow lending is cash flow lending. And I think, what I hope this conversation is helping, the listeners to understand is certainly our distinct perspective that that's really not the case.
Yeah.
There are ways to enter into what appears to be a crowded and maybe even commoditized market and find interesting and unique ways to pursue attractive returns for investors. So I think that's probably the biggest misconception, that it's not kind of all the same. When in reality, I think there's lots and lots of really, really important distinctions and nuances around not just managers, obviously, but also strategies within that broadly defined category.
What would you say if we're looking a decade from now? Not to make any predictions, but what would the industry need to improve upon most going through the next decade from, maybe the
Yeah.
lessons of the past decade?
I like that question a lot, maybe because I'm getting old. So I've been in private credit for long enough to sort of have seen, the old become new and then the new become old or whatever. It's probably too philosophical. I don't know what I'm talking about. But in all seriousness, as I think about kind of where we came from as an industry and where we're going, and if I think out over a 10-year horizon, a really long horizon, I think it really comes down to two things. I think the industry needs to find ways to become more transparent, um, number one, and then number two, to do a better job or to increasingly do a good job of educating investors about what it is we actually do. It's one thing to sort of say, hey, it's private credit and you can get a 10, 11, 12% yield. And it's
Yeah.
another thing to really explain on a little bit more of a nuanced level about what it is exactly we're doing. I think transparency is a question of people understanding the illiquidity of the underlying assets and how we in turn value them. And then, on the education front, look, I do think that private credit's an important part of every investor's portfolio, whether they're the largest institutional investors or someone's 401k. It's an important part of producing, current income for sure,
Yeah.
and diversification. So I think doing better educating the investors out there is going to be something you're going to see a lot more of over the coming decade.
One more question before we get to some fun questions as we get close to wrapping up. Obviously you referenced transparency and kind of the communication with investors a bit in your answer there. When you think about sectors or themes that could define, kind of this next wave of opportunity, I mean, is AI that answer? We just don't know the answer today, and that's kind of what will help define this market. Is there something else, like maybe it's sports and entertainment, that will help define this kind of next wave of opportunity in private credit?
Yeah, I mean, I think a couple things. One, I think increasingly over the next, say, 12 months to, 12, 18 months, I do think that there's going to be increased investor focus on, the middle market. I think there's a growing recognition. We talked about covenants already. That was my aspirational goal, that people really value covenants, because I do. But I think there's a growing recognition that
Yeah.
there's really multiple private credit markets, multiple direct lending markets, the really large firms, that's kind of that we used to call that the BSL replacement market. It's a different security.
Yeah.
So I do think that in the near term, you're going to see a little bit more focus on the lower middle market or the middle market, where you can really attribute more value or place more value on true lender protections. And then, so I think that'll be a near term change. I think a little bit more medium term change in your question, your reference to AI, something that we've been thinking about a lot is, I think AI is going to drive a lot of entrepreneurialism in this country, right? The barriers to entry, or whatever you want to call it, costs of a startup, right, are
Yeah.
getting lower and lower by the day. And what that really means is ultimately some of those startups are going to turn into small, medium enterprises, or middle market companies, another way to call it that, which just means there's going to be more companies in that SME category, small, medium enterprise category, they're going to be looking for that and need capital. And some of that will come in the form of private equity activity for sure. And a lot of that's going to come in the form of lending opportunities. So we're really excited about, holistically at a macro level, the impact that AI is going to have on our business, just in terms of growing the addressable market of middle market companies that are looking for capital.
One sidebar question I have to actually two. One is, do we need a terminology refresh? Because I think private credit today could mean a whole host of things. You
Yeah,
just referenced the segmented direct lending markets. You also have ABF, you have fund
sure.
finance, which
Yep.
could be its own category or category within ABF itself. So that would be my first sidebar question. The second is, where'd the name Andalusian come from?
Good one. So yes, I do think that we do need a kind of a reset in vocabulary, right? It kind of makes me chuckle to no end when some of these largest, private credit managers that manage, hundred or multi hundreds of billions of dollars, say that they're focused on the upper middle market. Like that doesn't make any sense to me. So I do think that we need to kind of figure out a new set of vocabulary words to help segment the market. I don't have any. I've tried a whole bunch of things. None of them have stuck. So don't I'll leave that for someone more creative than me to come up with. And the name Andalusian really goes back to, so we do have a couple of affiliated businesses. We are part of a broader platform. We've got a growth equity strategy that we're affiliated with, and we have a sports advisory business that we're affiliated with. And a lot of those initial businesses kind of came out of a relationship with David Tepper's hedge fund Appaloosa. So to really get really, really technical, it's a horse that starts with a letter A. So pretty creative, but now everyone knows. I wish it was a better story. I wish I could tell you I knew how to ride a horse, or I'm from Spain or something like that. But the reality is it's a horse that starts with a letter A.
So some fun questions, a bit rapid fire as we get to wrap up here. Favorite sports team or hobby?
I got to go with the Knicks, right? New York
Starting
born, and
tomorrow.
yeah, exactly. Starting tomorrow. No other answer for someone sitting in Manhattan would be appropriate. So Knicks.
One surprising thing about yourself.
My wife jokingly calls me the Forrest Gump of finance, or private capital. My first staffing and my first job out of school, to age myself, was long-term capital management. If that's a name any of your listeners can even remember, there's a great book called When Genius Failed that everyone should read. And in between that, all those years ago and today, I've been in the room and sometimes just carrying, the books and keeping my mouth shut, but in the room or involved in some of the biggest transactions, honestly, in history, including Procter and Gamble's acquisition of Gillette, MGM Mirage back again in my younger life. Was at the front seat for the financial crisis at Merrill Lynch and the B of A acquisition, and could tell a lot of fun war stories there. And then spent quite a long time, at BlackRock and then Apollo, where I got to watch both, be a part of both of those institutions, really going from, it's funny to call BlackRock a niche manager, but the world's largest asset manager, go from a few thousand employees to 20 plus thousand employees, and Apollo go from really a private equity firm to the largest I think private credit firm in the world today. So I've had a front seat to a lot of fun things.
Sounds like either a book or a podcast series.
Yes, sign me up, sign me up.
So you did reference a book there, so I'll go with the next question of the most exciting part of your job.
Whew, gosh, I think the most exciting part of my job is business building. We all live in a world, maybe more than ever, where you wake up in the morning and you have no idea what's going to be like sitting on your phone when your alarm goes off. And I'm not talking about like somebody quitting or the minutia. I'm talking about real big stuff, right?
Yeah.
Macro themes, wars, political stability versus instability. So business building in this environment has been really exciting. Some days scary, exciting. Some days really fun and exciting, but absolutely exciting.
And then final question is one prediction for the next 12 months.
One prediction for the next 12 months, I would say that the investors and allocators are going to be increasingly focused on differentiated private credit strategies, particularly in those sort of middle market and lower middle market, where you can actually still achieve attractive and unique and differentiated risk adjusted returns.
Knicks in 5, 6, or 7?
I'm going to go Knicks in 5.
That's what I think too. I don't think the Cavs are that good.
Yeah, agreed.
And they have James Harden on their team, so that's got to count for something.
That counts for, yeah, exactly.
I think that's a good
love
way
it.
to end it. Obviously, good luck to the Knicks. I'm also a New Yorker, so let's hope they do it. Thanks so much for your time, Aaron. Really, really appreciate it.
Thanks, Todd. This is great. Appreciate it.
Yep. Thank you. Thank you for listening to the Credit Clubhouse podcast. The Credit Clubhouse is brought to you by Deal Catalyst, the leading capital markets events and market intelligence company. For more information on Deal Catalyst events, surveys, and a whole lot more, please head to www.dealcatalyst.io. Thanks for listening. Until next time.